Welcome back to Trading Day. We've had a volatile couple of sessions, both to the upside and the downside. To help us understand all of this, let's bring in Ed Yardeni, who is the president at Yardeni Research. Here we are holding on to our gaze. It looks actually pretty mundane, Ed, if we didn't know what happened over the last couple of trading sessions.
Yeah.
How are you making sense of it all? I mean, can we just chalk this up to August nonsense, or is there something more here?
No, there's something going on here, and that is the carry trades have unwound over the past couple of days. A lot of speculators that had borrowed money over in Tokyo at 0% interest rates and used that money to maybe buy some Nikkei stock futures and then also convert a lot of it into other currencies like dollars to buy the mega cap 7 and the NASDAQ 100, maybe even the Mexican peso. I mean, it was a great trade. I mean, you borrow money at nothing and you just put it into the mega caps, the Magnificent Seven, and they just go straight up. Well, that trade started to fall apart when the Bank of Japan announced that they plan to increase interest rates fairly aggressively for them over the next few weeks. And that immediately led to a strengthening of the yen. And when you do a carry trade and borrow in Tokyo, you're in effect are short the yen, and suddenly the yen was going up. So the trade was going really badly, and they all scrambled on Friday and again on Monday. I think it's pretty much washed out, especially since the Bank of Japan has announced that, oh, by the way, they're going to hold off on raising interest rates after all, while the turmoil in the financial market straightens out. So I think that was it.
And yet there's still a consequence that seems to be lingering, even as you're saying, you know, I think we're done with that part of the sell-off, and that comes to the rate decision. There were calls. I just spoke with Jeremy Siegel, who was calling for an emergency 75 before a 75 cut in September. But even now, there's a 50 basis point cut priced in September. Is that going to come to fruition?
Well, I have a great deal of respect for my friend, Professor Siegel, but I think he's being overly alarmist here, quite frankly. I think when all is said and done, the economic numbers are going to come out demonstrating that Friday's employment number, which seemed to be awfully weak, was to a large extent a weather aberration. It was bad weather in July, and the Bureau of Labor Statistics made that clear in one of their series. In addition, if you take the 3-month average of employment rather than the 1 month, which can be very volatile month to month and gets revised, the 3-month average is basically back to normal. It's basically back to where it was before the pandemic. So I think the Fed's going to look at it that way, and I think they're going to be pushing back against an emergency rate cut, against a 50 basis point rate cut. And I think the data will very shortly show that the economy is pretty much still on track, growing with moderating inflation, and there's no rush for the Fed to accommodate the demands of either Wall Street or Professor Siegel.
So you're chalking this all up, the unemployment rate ticking up, jobs numbers coming in lower, to bad weather, not the fact that rates have been restrictive for a long time, and we're starting to see that come through?
Yes. Yeah, look, we've been saying for a while we didn't really see a need for the Fed to cut rates in September, but we recognized that the Fed was basically saying that's what they're going to do. So we accepted that fact. But in his press conference on Wednesday, Fed Chair Jerome Powell basically agreed with what we've been saying for a few months, and that is the labor market isn't slowing and going into a recession. It's normalizing. It's going back to where it was before the pandemic, without necessarily implying that we've got an employment-led recession up ahead here. So yeah, I think there was an overreaction to Friday's numbers on the labor and the employment market. I think there was a panic among carry traders on Friday and Monday that I think is basically over. So I expect the market to kind of churn here for a while until we get data that confirms what's really going on. And our bet is that the economy is still very much resilient.
So what does that do for the trade that's going to dominate, you think, to year end? Since the last inflation print, it's been all about rotation out of tech into everything else. I mean, the Russell, that gave it up very quickly in just in a matter of a couple of days. Do we go back to that rotation trade? Do we go back to tech dominance? How do you think about that?
Well, you know, the Russell, I think something like 40% of the Russell companies don't have any earnings. So the Russell is kind of a funky index to be watching. I much prefer the S&P 600, which is small caps, and the S&P 400, which is mid caps. And many of those companies actually have earnings. So I do expect that the broadening that we saw since that last CPI print will resume here. But I think the broadening will be more in the nature of the Magnificent Seven kind of moving sideways for a while, and money going into the not as magnificent 493.
And the rest of those, so you think that will sort of carry the day, and does that mean going into interest rate sensitives or more sort of cyclical areas like industrials? I mean, we did get real estate, for example, perk up.
Yeah, I like financials. I like industrials. I wouldn't get out of tech. I mean, if you've been following our lead, we've been bullish on the market since November of 2022. It actually bottomed the month before that. And we've been recommending tech, industrials, financials, and energy. Energy is sort of a shock absorber in the event of geopolitical risk. But we wouldn't be loading up on tech here, but semiconductors still look pretty like the fundamentals are going to be awfully good for a long time. But in the short term here, I think there's opportunities in the financials. I think the financials will do well as the yield curve is flattened out. Maybe it'll soon completely disinvert. And then if we find that there's no recession at all out there, then I think they should do extremely well.
Should we wait for inflation next week before deciding which way the wind is going to blow?
Well, I think the inflation news next week, there's something called Nowflation, which is a tracking model that the Cleveland Fed produces, and it's showing the CPI is going to be up something like 0.2, maybe 0.25%. That might unnerve some people, but I mean, let's get real here. We're talking about extremely low inflation on a month-over-month basis, and the year-over-year, I think we all recognize is going to have some issues because we're comparing to very low inflation numbers a year ago. But all in all, I think there's no reason to wait because I don't think inflation's making a comeback.